I'm Grant Walker. Welcome to Last Call for Tuesday, the 9th of June. And I'll be back with Heads Up Wednesday morning, 10 a.m. Let's talk broadband. New Zealand's retail fixed-line broadband market grew 5.3% last year, while data use per connection jumped 23%, with Spark New Zealand maintaining its market dominance according to the Commerce Commission's annual review. Fixed broadband connections reached 1.39 million as of June 30, 2014, from 1.32 million a year earlier, according to the Commission's 8th Annual Telecommunications Market Monitoring Report. Average data consumed per connection rose to 32 gig from 26. The latest review shows the continuing trend of growth in mobile at the expense of fixed-line services. Fixed-line calling volumes fell to 8.26 billion minutes last year from 8.98 billion in 2013. Mobile minutes rose to a record 5.3 billion from 4.77. Total retail telecommunications revenue fell to 5.17 billion in 2014, the second annual decline, while total telecommunications investment rose to 1.69 billion, the third annual increase. Although fixed-line broadband connections rose and have now reached 31 per 100 New Zealanders, total fixed lines were static at 1.85 million. Average broadband speeds based on the Akamai survey rose to 7.3 kilobits a second in 2014 from 5.3 in 2013 and just 2.7 in 2008. The number of unbundled fixed lines rose to 131,000 from 129,000 in 2013, while wholesale broadband lines, not Spark, rose to 463,000 from 455. Total fixed line retail revenues fell for a third year to 2.68 billion from 2.77 billion in 2013, while Spark's share of fixed line rental revenue fell to 58% from 60%. In 2006, it reaped 80% of such sales. In mobile, connections rose to 5.3 million from 4.9, amounting to 118 per 100 people. Of that, 63.6% were prepaid, up from 63.3% in 2013. Text messaging continued to decline to 12 billion in 2014 from 13 billion in 2013. Total mobile retail revenue rose to 2.49 billion from 2.44. Vodafone retained the largest market share at above 40%, although declining, while Spark and its Skinny brand continued to climb to about 35% and 2 Degrees held at about 24%. Spark's estimated internet service provider market share was unchanged at 49% compared with 32% for Vodafone. Call Plus accounted for 13% following its acquisition of Orcon, which had added to its Slingshot, Call Plus and Flip brands. All other competitors amounted to 6%. To our dollar, the New Zealand dollar advanced as the greenback weakened following reports US President Barack Obama raised concerns about the strength of the US dollar during the Group of Seven summit in Germany. The White House later denied the reports. The Kiwi rose to 71.41 US cents at 8 this morning. The TWI went to 74.78. The US dollar index, which measures the greenback against a basket of currencies, fell after media reports citing a French diplomatic source said that President Obama had told people at the G7 summit in southern Germany that the strong dollar is a problem. A stronger currency weighs on the competitiveness of industries and exports. Kathy Lean, Managing Director of Foreign Exchange Strategy at BK Asset Management in New York, said in a note, these reports were denied by the US government because they would never publicly stray away from paying lip service to their strong dollar policy. But in reality, the rising dollar is a problem for the Federal Reserve. There are two primary consequences of a strong currency: weaker exports and lower inflation. The US is not an export-dependent economy, and based upon the trade balance, the strong dollar has not been a major drag on export activity, but corporate earnings have suffered. Kimberly Martin, Senior Market Strategist at Bank of New Zealand, said in a note, the Kiwi may also be gaining support as some traders get cold feet ahead of Thursday's Reserve Bank meeting, where markets are split on whether New Zealand's 3.5% benchmark interest rates will be cut. Traders are pricing in a 43% chance that the RBNZ will cut this week, according to the overnight index swap curve. In New Zealand today, first quarter manufacturing data is to be released, as well as the Crown financial statements for the first 10 months through April, and the latest monthly housing data for May from State Valuer Quotable Value. In Australia, the focus will be on the release of the NAB Business Confidence Survey for May. The New Zealand dollar edged up to 92.67 Australian cents. today. Traders will also be eyeing Chinese May inflation data scheduled for release. China is the largest trading partner for New Zealand and Australia. The Kiwi slipped to 63.26 euro, gained to 46.53 British pence, and rose to 88.83 yen.
NBR Radio with the Property Press. It's out now to show you around.
In aviation news, Air New Zealand will increase its ability to land passengers from New Zealand to the Indian capital New Delhi following the announcement of a new code-sharing agreement between the national carrier and Air India. Improved air links have long been a priority for advocates of stronger business and trade links between the two countries, which are in the early stages of negotiating a free trade agreement. An existing code-share arrangement with Singapore Airlines and Air New Zealand allows connections to Indian destinations through direct flights from Auckland and Christchurch to Singapore and onwards to India. But Indian authorities are understood to have been slow to open up additional landing rights for SIA to the India's capital city. By code-sharing with Air India, which flies to Delhi from Sydney and Melbourne, Air New Zealand will be able to circumvent the current bottleneck. In a statement to Business Desk, Air New Zealand said in addition to the Singapore Alliance, which offers unparalleled connectivity to a range of Southeast Asia ports, Air India's connectivity through multiple gateways, particularly through its Sydney and Melbourne to New Delhi services, offer customers further choice to best suit their travel needs. Air New Zealand, Air India and SIA are all members of the Star Alliance network, and the new Air India code share will provide additional access to a range of Indian cities. An air services agreement between India and New Zealand in 2006, updated in 2008, allows for direct flights between Auckland and India's largest commercial centre of Mumbai, but no such services started, according to the Ministry of Foreign Affairs and Trade website. In March, Transport Minister Simon Bridges said at an India-New Zealand investment summit in Auckland that he hoped to negotiate a fresh ASA with India. Today's code-share agreement was signed at the International Air Transport Association annual meeting in Miami by Air New Zealand Chief Executive Christopher Luxon and Air India Chairman and Managing Director Mohit Nandan. Mr. Luxon said in a statement the sheer size of India and its growing middle class make it an aviation force that will positively impact international traffic flows. Close to 90,000 people currently travel between India and New Zealand every year, and this number is growing. Air New Zealand shares fell 1.1% to 283 and have gained 16% this year. The stock is rated an average hold based on 6 analyst recommendations compiled by Reuters, with a mean target price of 293. Now, a business update. The potential float of NBR rich lister Graham Hart's Carter Holt Harvey has been shelved pending greater certainty in the Australian timber market. The move was confirmed in a media statement. The company said changes in market conditions in recent weeks introduced a level of uncertainty to the earnings outlook of the Australian timber business. It went on. The new board of Carter Holt Harvey Group, in conjunction with the group's advisors, determined they were unable to finalise the forecasts in the IPO offer document, given the necessary level of confidence required as to the forecast's accuracy and probability of being achieved. Accordingly, until these circumstances become clearer, the IPO of the Carter Holt Harvey Group has been put on hold. The statement quoted Carter Holt Chief Executive Praful Kesher, saying the decision had the full support of current owner Rank Group. He said, while we were excited about the prospect of an IPO, it's the right decision in the circumstances to exercise caution and pause. The presence of cheaper timber imports in the market is said to have affected the company's confidence in its price forecasts. Carter Holt confirmed in May that an IPO was being considered and a prospectus had been expected to be published this month. It's understood the process has now been delayed indefinitely, possibly to early next year. Confirmation of the delay arrived as The Australian reported that ASX-listed conglomerate Wesfarmers, owner of the Bunnings retail chain, was interested in Carter Holt's building products chain carters. The newspaper speculated that the IPO was being delayed pending the outcome of talks about a possible deal. However, others see a Wesfarmers link as a red herring. While there is superficial logic to such a tie-up, a New Zealand source says institutional investors on both sides of the Tasman were wary of buying Carter Holt from Mr. Hart after their experience with Goodman Fielder. He said so he throws around a few names and lets people think he's pulled back on it because there's some trade interest out there talking to him. Just keep it bubbling along so he can live to fight another day. To the broadband rollout, Communications Minister Amy Adams wants to reduce consenting delays affecting an estimated 15% of households in the government-sponsored ultra-fast broadband rollout, proposing law changes that would make it easier for technicians to access properties with shared spaces. The Ministry of Business, Innovation and Employment is seeking submissions on a discussion document launched today on how to reduce unnecessary costs and delays associated with the UFB rollout. The document cites rules governing network operators' access to private property where land is in common ownership as the most pressing issue, causing about 15% of UFB orders requiring permission from neighbours that may be frustrated or delayed. Between 3 and 6% of all UFB requests are failing over consenting issues, and NBIE estimates some 60,000 households could be prevented from accessing the network as a result. Ms Adams said in a statement, "There have been frustrating delays faced by some customers and industry in installing broadband cables up shared driveways and in apartment complexes due to disputes and permission requirements. While the industry has a role in streaming the way they process UFB applications, the government is ensuring the regulations are fit for purpose." Last month, Chorus reiterated its push for legislative changes to the rules governing their right of access, which Chief Executive Mark Ratcliffe said was taking 6 times longer than a regular install in a standalone house. At issue was the requirement to notify neighbours who might be absent to confirm that they didn't object, or the ability of third parties to oppose an installation because of an unrelated dispute. Ms Adams told Business Desk the government was very careful about potentially cutting across private property rights, but that it wasn't appropriate for unreasonable disputes over shared spaces to hold up the major UFB infrastructure program. The Telecommunications Act, which governs right of access, will need to be amended, and Ms Adams plans to get legislation through Parliament as fast as she can. The discussion document puts forward 2 options to deal with the current framework, either deeming consent from third parties or provides an automatic right to install infrastructure on land based on Australia's regime. Any new access rights would probably include a sunset clause until 2025 to allow for the UFB network to be sufficiently established. Submissions on the document close July 24, after which Ms Adams will take her recommendation to Cabinet.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
In business news, Craig's Investment Partners, the brokerage planning to export its business model to Australia, posted a 14% decline in full-year profit as rising costs for wages, IT and rentals offset higher revenue from its private wealth or retail business. Profit fell to $15.2 million in calendar 2014 from $17.8 million in 2013, when share sales of government-owned companies helped drive activity in the stock market. Operating income climbed to $112 million from $109.5 million. Revenue from fees, which is garners from private wealth, climbed 12% to $61 million, and brokerage declined 7.4% to $37 million. Commission income was down slightly at $13.1 million. Craig's will know this month whether its push into Australia has been successful, with shareholders of ASX-listed Wilson HTM Investment Group set to vote on June 26 to sell its securities unit to managers Craig's and Deutsche Bank. Craig's chairman, Neil Craig, says ownership of the securities business will be similar to his own company, which is 50.1% owned by key managers and 49.9% by Deutsche, and there was scope to add value to the underperforming stockbroker. Mr. Craig said it's opportunistic to the extent it became available, and we've always had designs on wanting to open a business in Australia similar to what we have here. We think we can add significant value to make it more profitable, and from a client point of view, we think greater involvement in Australia will unearth lots of investment opportunities we would not find being a broker here. Deutsche was an existing investor in Wilson HTM and had facilitated the proposal. He said the purchase is to be funded with 5 million Australian up front, including cash, and 1 million Australian of vendor financing. It also includes a share of pre-tax earnings from the securities business in 2016 and 17, capped at a maximum of 1 million Australian in each year. Craig's would own 40% of the business, managers would own another 40%, and Deutsche would hold the remaining 20%. Neil Craig said increased operating expenses in 2014 weren't the result of any extraordinary items and tended to fluctuate year to year, reflecting the cost structure of its private wealth, institutional and investment banking businesses. It paid $12.6 million in dividends, or $15.75 a share, up from $12.3 million or $15.41 a year earlier. Employee benefits climbed to $63.9 million in 2014 from $60.9 million a year earlier. Communication and IT expenses rose to $5.1 million from $4.6 million, and rental and operating lease costs rose to 4.2 from 3.6 million. Mr Craig said 2013 had the tailwind of 3 large SEO IPOs, Meridian, Mighty River Power and Air New Zealand. Last year, he said, we only had Genesis Energy and it was smaller. Let's look at the government coffers. The New Zealand government reported an unexpected operating surplus in the 10 months through April, as the Crown's tax coffers were bolstered by a bigger inflow from portfolio investment entity tax and strong consumer spending. The operating balance before gains and losses was a surplus of 448 million in the 10 months ended April 30, compared to the forecast deficit of 555 million in the budget last month, and a turnaround from the year earlier deficit of 1.37 billion. Tax revenue rose 8.9% to 55.05 billion from the same period in 2014, and was 437 million ahead of forecast, with unexpected gains in PIE tax and the goods and services tax. Chief Government Accountant Paul Helm said in a statement, with April being the last significant month for PIE tax in this financial year, there is potential for this to be a permanent favourable variance from forecast at June 30. Above forecast GST suggests higher than forecast domestic spending, as indicated by strong March quarter retail sales. However, it's still too early to be confident whether or not this strength will continue through to June 30. Finance Minister Bill English has previously warned that achieving a budget surplus this year was looking less likely because of slow inflation and low interest rates, crimping returns on consumption and savings taxes, and said he wouldn't slash spending to artificially get the books back in the black. A deteriorating outlook prompted the Treasury to lower its forecasts further in the May 21st budget, projecting an overall deficit of 684 million in the 2015 financial year, with the 2016 surplus whittled back to 176 million. Mr English said in a statement today, we won't know whether we'll make surplus for the full year until we see the final accounts in October, but it's clear it will be a close-run thing. Crown expenses for the 10-month period were 420 million below forecast at 59.75 billion, with education spending tracking 171 million below expectations, core government services 200 million below forecast, and transport and communications 226 million lower than expected. Spending was 3.2% higher than the same period a year earlier, driven largely by an increase in welfare and superannuation payments. The Crown's spend on superannuation was in line with expectations at 9.59 billion, accounting for more than half of the government's transfers, while spending on income-related rents, a key plank of its social housing plan, was 47 million above forecast at 584 million. The operating balance, which includes unrealised movements in the Crown's investment portfolios, was a surplus of 795 million, compared to a forecast deficit of 863, due largely to lower than expected actuarial losses on the Accident Compensation Corp's claims liability due to higher interest rates. ACC's insurance liability was 34.76 billion as at April 30, 788 million smaller than expected, while the Earthquake Commission property damage liability was 570 million ahead of forecast at 3.31 billion. Net debt was 64.17 billion, or 27% of GDP, 278 million smaller than forecast, while gross debt at 85.52 billion, or 35.9% of GDP, was 624 million above expectations. The Crown's residual cash deficit was smaller than expected at 4.84 billion due to the increased tax take and smaller spending expense, and was down from a shortfall of 6.51 billion a year earlier. To house prices, New Zealand residential property values increased at their fastest annual pace in over a year, as Auckland housing prices clocked the biggest gain in over a decade, fueled by record migration and low interest rates. National property values rose 9% in the 12 months ended May 31st, the fastest pace in 15 months, and accelerating from 8.3% in April, according to state-owned Value Quotable Value. Meanwhile, values in Auckland, the country's most populous city, rose 16.1% in May, the fastest pace in 11 years and speeding up from April's 14.6% gain. The country's annual migration has broken records for 9 consecutive months, as people are lured by the nation's brighter economic prospects, recording a net gain of 56,800 migrants in the year through April. Half of the inflow is heading to Auckland, where an undersupply of housing has pushed prices to record levels. Meanwhile, the official cash rate remains on hold as the Reserve Bank looks to cool Auckland's bubbling housing market using other macro-prudential tools. QV National spokeswoman Andrea Rush said the usual winter downturn does not seem to have dampened demand, as high net migration, relatively low interest rates and a constrained housing supply continue to fuel demand in the Auckland market. This demand is also now spreading to provincial centres nearer to Auckland, with values up in Tauranga, Hamilton, Cambridge, Pōkeno and towns in the Hauraki district. Property values in Hamilton and Tauranga both increased 4.1% year on year as demand for Auckland spilled over. Wellington property values overall increased 2.6% year on year, but Central East and South Wellington recorded a decline, offset by gains in Lower and Upper Hutt and Porirua. Christchurch values increased 3.8% in the year.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the courts. A loan from a sister company of failed Hanover Finance would never have been made to a now bankrupt and disbarred lawyer had the true financial position been known, a court has heard. FAI Money, of which Hanover co-founders Eric Watson and Mark Hodgson are directors, lent $300,000 to Edward Errol Johnston for a Waitakere property in late 2009. Mr. Johnston has since been bankrupted and struck off as a lawyer, with the property the sole asset of a trust. But the lender has been chasing the trust's two trustees, Mr. Johnston's father-in-law, Gavin Crawley, and Mr. Johnston's brother, Rick Johnston, as being personally liable for the debt since 2012. Yesterday, the case resurfaced before Justice Patrick Keane in the High Court at Auckland. FAI Money had already successfully extended freezing orders on assets owned by Mr. Crawley and Rick Johnston, who was in court yesterday, in August last year, pending judgment in this week's substantive claim. The lender's lawyer, Brett Gustafson, told the court yesterday the loan was obtained using false financial information. The trust that owned the property claimed assets of $1.5 million, representing the 9,000 square metre section in Swanson, and no liabilities. Mr. Gustafson says, but it was also already mortgaged to Westpac from 2004 to a limit of $1.1 million. And where Mr. Johnston provided an updated financial position 2 years later, liabilities had increased markedly. The property was now encumbered in the sum of $3.7 million to Westpac, $80,000 to Dorchester Finance, and $225,000 to a party called Rayland. Mr. Gustafson says the evidence of FAI Money Chief Executive Kerry Finnegan, the former Chief Executive of Hanover Finance and Strategic Finance, will say the loan would never have been made if the true financial position was known. He said there is no doubt that the financial information provided in April 2009 was false. He says the most contentious point between FAI Money and the defendants is whether the lender has a claim against the trustees. But if the trustees act fraudulently or negligently to cause loss, then they may be personally liable, which he says is the case in the actions of Mr. Crawley and Rick Johnston. The hearing, which is set for 4 days, continues. In media news, Spark-owned Lightbox has added support for Google's Chromecast widget and Panasonic smart TVs to its device lineup. The $69 Chromecast streaming media player gives subscribers a wireless way to get Lightbox onto any modern TV screen with an HDMI port. Lightbox is now also available on selected Panasonic Viera smart TVs. Chromecast is a small device that plugs into the HDMI input on your TV and uses your home Wi-Fi network to stream video content. Using the Lightbox app on an Android phone or tablet, or Lightbox's iOS app for iPhone or iPad, users can cast Lightbox shows direct to the big screen. Lightbox Chief Executive Kim Niblock says, "We've streamed the equivalent of 7.4 million hours of TV since launching. It's clear our viewing habits are changing, as many New Zealanders are now watching their TV via the internet. We know our customers love watching Lightbox on the big screen. We've seen big screen viewing increase by more than 400% since we launched our first smart TV app last November. Adding Chromecast and Panasonic means we can put Lightbox into the homes and onto the big screens of even more TV lovers, and it's perfectly timed to provide great TV options during the cold winter months ahead." Lightbox is already available through Samsung smart TVs, desktop PCs, laptops, Android tablets and phones, iPads and iPhones, and via Apple TV, plus PlayStation 4 and PlayStation 3 consoles. The streaming video service is playing catch-up with Netflix New Zealand, which is the market leader in device support, including Xbox, all major brands of smart TV, and a native app on the invitation-only Apple TV. QuickFlix is a close second, with Lightbox gaining ground in third. Sky TV's Neon currently has the most limited device support.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland and I'm joined in the studio by reporter Jason Walls, who's been looking into a new report just released from the New Zealand Taxpayers Union, who's been poring over the 2015 budget. What have you found, Jason?
The report goes into detail about the extra areas of funding within the budget, and it has a lot of explicit details. For example, it talks about corporate welfare, and that was one of the big issues. In fact, I think it was the headline issue in the report. And it's talking about how corporate welfare, which is essentially business subsidies, has increased and will end up costing the taxpayer $1.35 billion a year. So when you work that out and you bring it back to the average household, it works out to be about $752 per household. So it's actually quite a lot of money. And so, I mean, there's always the ongoing battle between the left and the right in the political sphere here about whether that money is being put to good use and is it better off in the pockets of the taxpayer or the government paying on behalf. So this report really goes into detail and talks about some of the things involved in the budget. It gives examples for like Kiwi Rail, Solid Energy, which are being propped up by the taxpayer.
So I'm assuming the Taxpayers Union won't be too thrilled about this new and higher cost to taxpayers.
No. And I recall after the budget that they gave the budget itself about a 2 or 3 out of 10. So I don't think they were too happy with it. And basically it was 26 pages of, nope, we're not happy with this, and outlining a few of the things that are going wrong. Particularly critical of funding for science and innovation, I might note, where funding was increased from the last budget by 20%. So it's quite a bit. Also, something I noticed was that funding for cultural and arts was increased by upwards of 90%. So although it's not at the level of where science and innovation is, where it's upwards of 200 million, I think creeping up to 300 million, it's only at 40 million. So it's still quite a lot of, it's a massive increase. When I say 90%, alarm bells going off in taxpayers' heads, but you got to kind of keep that in context as well. The report says that subsidies are underwriting private businesses and entrepreneurs, which would have otherwise been in line for these profits when it comes to science and innovation. Kiwi Rail, for example, was mentioned in depth within the report because it's basically the largest item of corporate welfare within New Zealand, and it's costed taxpayers, according to the report, $13.2 billion since 2008.
I note that on their website, the report's entitled Any New Kids at the Trough. Did you identify any new kids that are receiving this government largesse?
There was quite a lot of things. I think there was things that received less funding. There was things that received more funding. But I thought it was quite an interesting title, but it summed up basically a lot was in there here.
Yeah, and finally, I mean, were there any recommendations as to the way forward from the Taxpayers Union?
Yeah, there was. It was sort of something that we've been hearing before in this sort of area, which is basically they were calling the government to re-examine whether it thinks taxpayers should continually pay to prop up businesses that show little signs of turning around. So basically they were talking about Kiwi Rail and Solid Energy that have shown in the past some poor performance, and taxpayers are the ones in the end of the day that are helping to subsidize that. And they were quite critical of the fact that if a business is failing, that it shouldn't be on the taxpayer's burden. We shouldn't be paying that, and we should just let capitalism be capitalism. And if they're not performing, well, then they just fall at the wayside, basically.
And what about in terms of the company tax rate? Do they have any thoughts about that?
Yep, they want, no, surprise, they want that cut from the current level at 28% to 22.5%. So it's about quite a big drop there, and they say that it would have huge ramifications within New Zealand business community.
Thank you. That's reporter Jason Walls.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To overseas pensions, Inland Revenue has been holding discussions with its UK counterpart to try to sort out the mess left after all KiwiSaver schemes were removed from the list of recognised overseas pension schemes. The UK legislation, which came in on April the 6th, has imposed a minimum age requirement of 55 years to access funds transferred from UK pension schemes to qualifying registered overseas pension schemes, or QROPS. All KiwiSaver schemes have been removed from the approved list as they let people withdraw funds before the age of 55 through financial hardship, first home buying or permanent migration. The exact number of people affected is not clear at this stage, but tax experts believe it will affect a large number of British migrants who've moved to New Zealand and brought their superannuation funds with them, and returning New Zealanders who contributed to a UK pension scheme while working there. An IRD spokesman confirms to NBR Radio it's been in discussions with Her Majesty Revenue and Customs, which brought the law change in. The IRD expects to have a resolution from HMRC early next week, which may provide relief for the New Zealanders caught up in the changes, according to a spokesman. Because KiwiSaver schemes no longer qualify as a QROPS, any transfers after April 6 from a UK pension scheme to a KiwiSaver scheme could be treated as an unauthorised payment by the UK tax authorities. The transfer can attract a UK tax penalty of up to 55% to be paid by the individual transferring. Scheme sanction charges can boost the punitive payment to 70%, although the extra is covered by the provider. The risk of triggering a UK tax liability also exists if someone makes a withdrawal from their KiwiSaver scheme before the age of 55. This means if someone aged 40 transferred their UK super to a KiwiSaver scheme in 2012, and stopped being a UK tax resident at the time of the transfer, then withdrawing those funds to acquire a New Zealand first home in 2015 would potentially trigger a UK tax obligation of up to 55% of the withdrawal amount. Charter Square Director Simon Swallow says the biggest issue remains for people who are in the middle of transferring their unfunded UK public sector pensions and are now left in limbo after their statutory right to transfer out was removed on April the 6th. Charter Square is trying to get a change put through Parliament and with the IRD that will allow a temporary exemption for those in KiwiSaver schemes to transfer out to a non-KiwiSaver QROPS scheme. Mr Swallow says the changes were brought in because a number of different countries were offering people the chance to take their funds before they hit 55 years old, and HMRC did not want that. Mr Swallow says New Zealand is not the only country to be hit. It's likely 90% of the more than 1,000 Australian QROPS will disappear from the list on June 17, when they're required to have reported on whether their trust deed meets the requirements of no payments before recipients are 55 years old. He says most will not, as they almost all allow for early payments under financial hardship, something that is ingrained in Australia. Similarly, Irish QROPS schemes allow for early retirement at the age of 50, so it's likely that the majority of them will be scratched. To the manufacturing sector, New Zealand manufacturing activity shrank in the first 3 months of the year as meat and dairy volumes declined in a period when global milk prices remained under pressure and parts of the country were stricken with drought. According to Stats New Zealand, the volume of total manufacturing fell a seasonally adjusted 0.3% in the 3 months ended March 31st, turning around from 2 quarters of 0.6% growth and up 0.4% from the same period last year. The quarterly decline was added to by a 1.5% drop in meat and dairy product manufacturing, the sector's biggest quarterly contraction since June 2013. Other sectors reporting a dip in the quarter included fruit, oil, cereal and other food manufacturing, which shrank 0.8%. Wood and paper product activity fell 0.6%. Printing dropped 6.5%, chemical, polymer and rubber products declined 1.9%, and metal products manufacturing slipped 4.3%. Business Indicators manager Neil Kelly said in a statement, meat and dairy has fallen in 4 of the last 5 quarters, following a large rise in the December 2013 quarter. Without the meat and dairy contribution, the combined sales volume in the remaining 12 industries was unchanged, despite a large 12% rise in petroleum and coal products. New Zealand's manufacturing activity has been expanding for the past 30 months, and the Business New Zealand Bank of New Zealand Performance of Manufacturing Index, due this week, is expected to show the sector continues to grow, even as weak dairy prices and a slowing Australian economy sap some demand for industrial production. Today's data shows the value of manufacturing sales fell a seasonally adjusted 2.8% in the quarter, its 4th successive decline, and was 6.8% lower than the same period a year earlier at an unadjusted $23.76 billion. Petroleum and coal product manufacturing was the standout in the series, with volumes up 12% in the quarter, even as values shrank 9.3%, while beverage and tobacco product volumes gained 1.7% for a 3% rise in the value of sales. The value of raw materials ended the quarter at $3.62 billion, down 1.1% in the 3-month period, and is 3.3% below the same time a year earlier. Finished goods at $10.66 billion were 2.7% higher than the December quarter, though still 17% lower than a year earlier.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland, and joining me is Jenny Ruth with an update on the Contact Energy story. Jenny, there seems to be mounting speculation about Origin selling out its majority stake.
There is indeed. Origin owns 53% of Contact and has done for many years. One of the things that this rumour has been around for more than a year. Was actually not really a rumour, more speculation. But one of the things that sort of heated it up lately was 2 weeks ago Contact said that it wasn't going to be buying anything offshore, and investors were very happy to hear that because they didn't like that idea, and that it would return $367 million to shareholders, and that's by way of a special fully franked dividend of 50 cents a share. And it's basically going to use up Contact's available franking credits. Now, there are all sorts of ways you can return capital to shareholders, and people have been asking themselves why they chose a fully franked dividend rather than, say, a buyback. And, it looks like that possibly Origin's trying to make Contact look as clean and attractive as possible for a sell down, perhaps.
Yeah, there has been some suggestion that Origin does no longer views Contact as a core asset. Is Origin under some sort of pressure to sell?
Origin is under a lot of pressure on its balance sheet. I have to add that it has come out and said that it's committed to remaining an owner of Contact. But that's more in the nature of, well, they would say that, wouldn't they, until and unless they were actually ready to sell right now. But Origin's balance sheet is very stretched. It's committed to this 25 billion Australian dollar LNG project in Queensland. It owns roughly a third of that project. And in April, Standard & Poor's downgraded its credit rating to BBB minus, and that's basically the lowest rung of investment grade. And the last thing Origin wants is for its credit rating to fall any lower. The economics of the LNG project aren't looking that great because oil prices and therefore LNG prices have fallen considerably over the last year or so. And the most obvious way that Origin could shore up its balance sheet in the short term is to sell something. Now, it has talked about asset sales, it hasn't talked about what it would sell, but clearly you'd have to say there's a question mark over the Contact stake.
What about potential buyers? How much appetite would there be locally or offshore for their 53% stake?
Well, you have to remember in the last couple of years the government sold nearly half of 3 of the generator retailers listed on the New Zealand market. So is there appetite for another company, 53% of another electricity company? Contact's certainly a quality asset. The other option would be a trade buyer, but you look around and say who would buy it, and you'd have to think that the 3 government-owned ones wouldn't be in the market, and that leaves Trustpower. Well, Trustpower's got its own problem. Infratil owns a majority stake, and the Tauranga Consumer Trust owns another large chunk of Trustpower. So, would those companies, would those shareholders be willing to buy this asset? Don't know. And, of course, there's always an offshore buyer. However, people are pointing to the Z Energy purchase of the Chevron assets. Well, actually, they bought Chevron New Zealand shares, not the assets. And looking at the multiple they are buying that for, which is 5.9, and that's well below the multiple that Z Energy shares trade at. I think theirs is 8.9, or it was before they announced the purchase of the Chevron New Zealand. And so people are, normally the rule of thumb is that a trade buyer will pay more than portfolio investors on the share market. However, in this environment with very low interest rates, people are suggesting that the reverse is true now, and saying that the Chevron deal is an example of why that's changed.
Well, as they say, Jenny, watch this space. That's NBR journalist Jenny Ruth.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Corporate welfare costs each of us $750. The Carter Holt IPO is called off. Crown accounts unexpectedly in surplus. Manufacturing activity shrinks. Primary sector exports fall, and house prices just keep on climbing. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. In business news, speculation is mounting that Origin Energy may be a seller of its 53% stake in Contact Energy. Contact announced 2 weeks ago that it can't find any suitable investments, reversing February's statement it was looking for offshore geothermal investments and will return $367 million to shareholders by way of a special fully franked dividend of 50 cents a share. That's added fuel to the speculation. Harbour Asset Management Director Craig Stent says paying the special dividend largely clears out Contact's imputation credits, and that has led some investors to read into this that the shareholding structure may be up for review. He says at a stretch that could mean that majority shareholder Origin is readying the business for sale. Mr. Stent says that in a presentation to investors in Sydney last month, Origin Managing Director Grant King, who is also Contact's chairman, highlighted that with a sustained period of low oil prices, the company had less balance sheet flexibility. Mr. King placed 3 options on the table: reduce Origin's capital and operating costs, realign debt across the group, and divest assets. Mr. Stent says if Origin sold its Contact stake through a trade sale, the only potential local buyer would be Trustpower, but that company has obvious issues given its ownership. Infratil owns 51% of Trustpower, and the Tauranga Energy Consumer Trust owns nearly 27%. New Zealand equities manager at JB Ware, Ricky Ward, says Origin has indicated the Contact stake is no longer a core asset. He said it used to be a large part of the overall business, but now it's minor. Contact's statement on the special dividend is telling you it's going to become a localised gentailer that's going to return cash to investors. They're trying to make it look as attractive as possible, he says. For more on this, go to nbr.co.nz. In business news, Danone Nutricia, the French-owned infant formula maker, has reported a full-year loss it attributes to continuing fallout from the Fonterra botulism scare in 2013. The New Zealand subsidiary of the French food giant posted a loss of $1.19 million for calendar 2014, compared to a profit of $1.99 million a year earlier. Danone Nutricia ended its supply contract with Fonterra and launched a $1 billion lawsuit against the dairy co-op early last year. That followed its sales being disrupted in August 2013, when it had to recall 67,000 cans of its CarryCare infant formula in New Zealand, triggered by Fonterra's milk powder contamination warning. The whey protein was ultimately cleared, but only after a recall of baby formula products due to concerns children could be harmed. Chief Executive Corin Tapp was unavailable for an interview on the company posting a loss, but said in a statement that while recovery from the recall is still ongoing, this includes costs incurred transitioning to alternative ingredient suppliers following the botulism scare. Revenue for the year was $252 million, down from $318 million the previous year, while expenses rose to $57.5 million from $50.1 million the year before. Before the recall, the company reported revenue of $143.5 million and $14.5 million profit in the 2012 financial year. No dividend was paid in the latest year, although related party transactions included $2.75 million of interest paid on a $74.4 million loan from the parent through Nutricia International BV, which is a key source of funding for the company. The loan had increased from $63 million the previous year. Last year, Danone Nutricia bought 2 New Zealand dairy processing companies, the Sutton Group and Guardians. Sutton is best known for its infant formula manufacturing, while Guardians operates a milk powder spray drying plant in Balclutha and provides access to milk supply from its 18 farms. Ms Tapp said last year the company intended doubling the capacity of the plants to meet growth expectations. The cost of the acquisition was not revealed at the time of the purchase or in the end-of-year accounts. Danone Nutricia lost a legal bid in November to overturn a High Court decision stalling its legal action against Fonterra. The High Court had ruled the company should attend arbitration in Singapore before any court case in accordance with their supply agreement. Danone Nutricia argued that the arbitration award was not due to be released until the middle of 2016, which meant it would have been effectively delayed by 18 to 24 months, pushing out any damages to 2018. But Justice Douglas White said there was a real risk of injustice to Fonterra if the group was diverted from the Singapore arbitration by taking further steps in the High Court action. Fonterra has said the supply agreement limited the liability cap to 10 million Australian per claim and 30 million Australian a year rather than the 350 million euro damages sought by Danone Nutricia.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland, and joining me in the studio is Hamish McNichol. Hamish, you've been digging into an interesting legal dispute over a loan by a Hanover Finance subsidiary, FAI Money. Tell me about it.
Yeah, so this has been banging around the courts since about 2012, actually, but finally this week we've got to the substantive hearing, and it's set to take a couple of days. Basically what it's about is this Hanover sister company, FAI Money, which lists Eric Watson and Mark Hodgson, who are the co-founders of Hanover, as its directors. They lent $300,000 to this lawyer called Edward Errol Johnston for a Waitakere property in late 2009. But this Mr. Johnson has since been bankrupted and struck off as a lawyer. And the property was the sole asset of a trust. And now the lender, FAI Money, is trying to get back that loan from the two trustees of that trust, Mr. Johnson's father-in-law, Gavin Crawley, and his brother, Rick Johnston, who was in court yesterday, actually. So who, just to refresh our memories, who is the beneficial owner of FAI Money now? It was described in court yesterday as a sister company of failed Hanover Finance. So I know that Watson and Hodgson are the directors of it, but other than that, I'm not entirely sure of the shareholdings, to be honest. But basically, it is these. There's certainly, one of the witnesses called yesterday was a Hanover employee who had been called in to look at these documents and things like that. So there's a very close relationship between the two companies. In the great scheme of things, $300,000 almost seems like a paltry amount. Yeah, but I don't know. It's an interesting little case, this one. There seems to be other history between the parties and this lawyer Edward Errol Johnston with other property investments that we had stories on a couple of years ago. So I'm not sure exactly sort of the depths of the dispute, but they're certainly trying to claim back that $300,000 at least. And I guess this raises the issue for trustees in that. FAI Money has obtained freezing orders on the assets owned by the trustees, Mrs. Crawley and Johnston. Yeah, so those freezing orders were obtained in August last year, pending whatever the judgment is in this week's substantive claim. So basically, the claim is from FAI Money. Their lawyer, Brett Gustafsson, yesterday said basically that the loan for this property was obtained using false financial information, and because of this, the trustees have acted fraudulently or negligently to cause loss, which means that they could be personally liable for it. So their argument, of course, is that no, we didn't act dishonestly or fraudulently, so we aren't personally liable for the debt. So is there any lingering connection with either Mark Hodgson or Eric Watson in terms of their involvement in this case? Well, just purely the fact that they're the directors of this company. And so what's happened is that the loan was used to buy a property which Mr. Johnston said was worth $1.5 million. And so that asset was transferred into this, the ownership of this trust, which was also said to have no liabilities at all. And so basically it looked like it was a good investment, but then it actually transpired that that property was already mortgaged to Westpac from 2004, and its limit was extended to $1.1 million in 2007. And there was also a financing deal with Dorchester Finance and another party called Rayland. So Whilst when he initially got the loan off FAA money, he said, yep, assets 1.5 million, no liabilities. It actually later transpired, I think it was about 2 years later, that the property was now encumbered in the sum of $3.7 million to Westpac, and then those same sums to Dorchester and Raylan.
Well, we look forward to your coverage of this substantive hearing, Hamish, and perhaps a bit more dirty washing coming out into the public.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
In business news, Pushpay Holdings, the mobile payments app developer, is in talks to expand its contract with US software developer Church Community Builder as it graduates to the main board on the NZX. The Auckland-based company expects to sign a new referral contract with Church Community Builder in the next 4 weeks, which is likely to lift the number of churches which use PayPal's system to collect money from parishioners. The mobile payment services company disclosed the talks as it moves today from NZX's small-cap NZAX market to the main board, as the negotiations may be material information, it said in a statement. The company said the proposed new contract is likely to involve Church Community Builder referring merchants to Pushpay, and Pushpay paying Church Community Builder a fee for the referral services. The value of this contract is likely to be driven by the number of new merchants that Church Community Builder can refer to Pushpay, and it is possible that the referral arrangement, if completed, may result in an increase in the rate of consumer acquisition in the US. Pushpay is targeting the US faith sector for growth, where there are more than 314,000 churches with an average 500 attendees each. In the first half of its current financial year, the company aims to push its merchant numbers above 2,000. That's more than double the 996 merchants it had at the end of the 2015 financial year, 87% of which are in the US, and 158 merchants at the end of its 2014 year. Last month, the company said it increased its annual loss to $7.5 million in the year ended March 31 from a loss of $1.6 million a year earlier. Sales revenue soared to $4.8 million from $316,000 a year earlier, while expenses jumped to $12.7 million from $2 million. Shares of Pushpay last traded at $3.85 on the NZAX, up from its $1 listing price in August last year. Market news. NZAX-listed TrueScreen is looking to raise up to $1 million from investors in a share purchase plan after the cervical cancer screening system's private placement came up short on its upper target of $4 million. The Auckland-based company raised $3.27 million from institutional and eligible shareholders last month, short of its $4 million upper target but above its $3 million minimum. It will now offer existing shareholders up to 60,000 shares each at 25 cents, a half-cent discount to the stock's current price and the same price at which it offered shares in the placement. The company plans to ramp up manufacturing of its single-use sensors as it targets China, where it recently won regulatory approval from the China Food and Drug Administration to service the world's most populous nation with its cervical cancer screening system. TrueScreen has entered into a joint initiative with the China Doctors Association and its principal Chinese distributor to run a screening program covering 100,000 people in 100 hospitals over the next 12 to 14 months. TrueScreen listed on the NZAX last November in a compliance listing, having already raised $6.07 million in the lead-up to going public. That private placement was to acquire the intellectual property and assets of the business and provide working capital to fund the commercialisation of the product. The shares last traded at 25.5 cents, valuing the company at $40.2 million and above its 10-cent issue price last year. Business Desk receives funding from Callaghan Innovation to assist coverage of the commercialisation of innovation. To corporate welfare. A new report claims the cost of government's corporate welfare this year will be almost 12% higher than 2014, costing the average New Zealander more than $750 a year. The latest report from lobby group Taxpayers Union says corporate welfare will cost taxpayers more than $1.3 billion this year, an annual increase of more than $150 million. The report notes subsidies for science and innovation have increased by almost 20% from last year's budget. It argues the taxpayer-funded subsidies in this area are in large part grants to private businesses for commercialisation of science discoveries. Taxpayers Union Executive Director Jordan Williams says corporate welfare robs middle-class taxpayers to reward the well-off and politically connected. He says for every dollar spent on corporate welfare, there is one less dollar for education, health or investment by the taxpayer who earned it. State-owned enterprises also come under fire in the report, which outlined the largest item of corporate welfare is still KiwiRail, having cost taxpayers $13.2 billion, including write-downs since 2008. It says the unwillingness of governments to walk away from failing state-owned businesses is an ongoing risk to taxpayers. The link, it says, between profits, innovation, cost control and even good customer service are being uncoupled by this government's willingness to get out the taxpayer chequebook. The lobby group is calling for the government to re-examine whether it thinks taxpayers should continually pay to prop up a business that shows little sign of turning around. It also claims a reduction in the company tax rate from 28% to 22.5% would result in greater competitiveness for overall New Zealand businesses and increase the ability of those firms to employ more people.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To the primary sector outlook, New Zealand's primary sector export revenues will probably drop 8% to $35.2 billion this year due to a substantial decline for dairy and forestry products, although the outlook for the next 4 years is rosier. The Ministry for Primary Industries' latest Situation and Outlook for Primary Industries shows revenue for dairy, the traditional heavyweight in the primary sector, accounting for 40% of total export revenue, is expected to decrease 22% to $14.2 billion in the year ending June 30, 2015. Forest products are forecast to fall 10% to $4.63 billion. The slowing Chinese economy and real estate market, coupled with high log inventories and the potential for more Russian imports, mean the outlook remains tough for log and timber exports into China for the rest of the year. MPI Director Jared Mayer says it's been a tough year with volatility in overseas markets for some of New Zealand's key export commodities and challenges to production from climatic events such as droughts, storm and floods. The report gives a positive outlook through to 2019, with total primary sector export revenues expected to be up 17% from 2015 to $41.3 billion, underpinned by income and population growth in China and Southeast Asia and a recovery in the US housing market. China remains New Zealand's most important export market, despite a reversal in the strong demand for dairy and an end to the construction boom that earlier lifted forestry export earnings. Mr. Mayer said excessive inventories and slowing construction have reversed these price gains for the 2015 year. We expect the Chinese economy to slow down a little bit, but still remain our largest export destination, with continued strong growth from ASEAN countries and longer-term demand from India. The big change in India will come when a strong cool chain is established that will mean that premium end primary products don't deteriorate too fast in the hot climate. That's starting to be developed now. We expect apples to be a forerunner into that market and other products such as timber, Mr. Mayer said. Overall, he said he expected horticulture to perform strongly in the next 4 years, dairy to recover, and some high-value niche products to start making their mark. He said, I'd watch for a lot of food products where some new innovation is coming out, including in existing categories such as dairy. It's about that switch from commodities to high value. We've seen that quite significantly in the past 2 years. Offsetting this year's drop in dairy and forestry were higher beef and veal prices, growing demand for seafood, a recovery in the kiwi fruit industry, and higher wine exports. The small but growing other primary sector category is also forecast to lift 26% this year to $1.96 billion on the back of demand for innovative processed foods, honey and live animal exports, mainly driven by dairy cow exports to China. The report expects China's import demand for dairy to recover during the June 2016 year, although the high prices achieved in 2014 are unlikely to return. Overall, dairy export revenue is forecast to grow at a compound annual growth rate of 6.8% from 2015 to 19, starting in 18 months. For more on this, go to nbr.co.nz.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland. New UK legislation has imposed a minimum age of 55 years for people to access funds transferred from UK pension schemes to qualifying registered overseas pension schemes, the so-called QROPS. Reporter Calida Smiley has been looking into the implications of this for those living in New Zealand. Calida, what have you found?
Yes, well, there's quite a number of implications. The main one being is that all KiwiSaver schemes have been removed from the approved list. And this is because they offer benefits to people before they turn 55. So that's things like you can withdraw the money to buy your first house, you can withdraw it in deep financial hardship, or also permanent migration. And now, so transferring to KiwiSaver from these UK pension funds could attract a tax penalty of up to 55% of the money transferred, and the scheme provider will be penalised as well.
Do you have any idea of who's actually affected by these changes?
Well, the tax experts that I've spoken to so far can't give me any solid figures, as that's pretty hard to do, but it will affect any migrant from the UK who hasn't yet brought their pension over with them. It will affect people who are in the process of transferring, and I think these people are in the biggest group of really having trouble here, and also people who have already transferred but then want to withdraw the funds early to maybe buy their first New Zealand home. And it also affects any Kiwi that's gone over to the UK, perhaps on an OE for a couple of years, and contributed to a UK pension scheme, which is quite a common scenario.
So what are the options available for those who are impacted by this?
Well, the IRD and KiwiSaver providers are still working through that. And I've just heard from the IRD this afternoon that they've been talking with the HMRC in the UK, now that's the tax body in the UK, about possibly fixing this. And the IRD spokesman that I spoke to said that we would likely hear more about that on Monday. And then when I talked to a tax partner at KPMG last week, Rebecca Armour, she said the issue will go on as long as it takes to get a New Zealand legislative fix, such as allowing KiwiSaver schemes wanting to remain registered to opt out of a first home, financial hardship or other withdrawal criteria.
I mean, grumbles about the transferability of UK pensions to me seem to have been going on almost forever. Mm-hmm. It's very complicated. Mm-hmm. You're working your way through this, so there's much more to come, I guess.
Yes, there will be more to come, and it will be interesting to see whether the IRD manages to come up with a solution to this.
Thank you, Calida. That's Calida Smiley.
NBR Radio. Free to air online with business news you can use.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland, and welcome to our weekly edition of Property Talk with Sally Lindsay and Chris Hutchings. And Sally, tell me about this rates protest that is happening in Auckland.
Tomorrow night there's going to be a meeting, a public meeting. Anybody can attend it, and it will be solely focused on the rates increase in Auckland. The average rates are going to go up by 9.9% this year, and that includes the transport levy of $2 a week for residential houses and $3 a week for businesses. And the rate increase, that's the average, but for some properties, particularly in poorer areas in South Auckland, are going to go up by 16%, and even in some of the more affluent areas will go up by 20%, and there'll be no rates smoothing this year. That last year was the last time that happened. So people are really angry about this in Auckland, as they feel that it's too much, and even the Prime Minister says Aucklanders cannot go on accepting rates increases at that level.
Well, my rates have been capped at 10% for the last 3 years, when it's meant to be an average of 3. So, I mean, the sky seems to be the limit at the moment.
That's right, and the Mayor has campaigned and said on many occasions that he would keep rates to 2.5 to 3.5%, and then when they had the long-term plan meeting and then they discussed the transport plan, that all just went out the window. They just decided that people would pay to start the City Rail Link and other transport projects, and this would be paid through by the levy, because the government won't come to any funding arrangements until the City Rail Link proves that it's got the passengers and it needs to go ahead. But so there are a lot of people going to be talking at this meeting. There's going to be the political parties, local MPs, local councillors, and other people, campaign protesters that have been around for a long time. And there's going to be, I would say, quite a lot of anger, but they're also going to come up with a plan of how they can let the council know how they feel about this, and maybe something can be done about it. Chris, I understand that's sort of similar in Christchurch, so what's happening down there?
Well, that's right, Sally. We had a positioning statement, which I'm going to write about for online today, I think, from the Mayor, saying what she would prefer. And we were staring down the barrel of 33% rates increase over 3 years. She's bringing it down to, listen to this, 29%. Now, it's just ridiculous. The trouble is, that seems to mean bureaucracies have got their own momentum. Now, when they're doing their own budgets, you're not going to find staff members turning on each other's work programs and saying, you've got to downsize, you've got to get rid of a few part-time workers, we're not going to conduct this. There is this complete air of unreality in Christchurch, and I think it's probably the same in every centre, where we have some councillors here that represent some of the poorer areas. Now, those people are desperate for amenities, expensive amenities, millions of dollars worth of amenities, and they're trying to push these into the council budgets, and yet their own constituents are the ones that can least afford to pay these rates increases. Admittedly, by percentage-wise, their rates increases will be less because their properties are valued at less than people in some of the wealthier suburbs. But, you start to tear your hair out. I mean, how long can we sustain this kind of thing where you're getting it every other year at these ridiculous levels? The inflation rate is 1.5%, and heading us up with these rates increases approaching 10. Does it take no imagination to figure out how this sort of thing compounds in about 10 or 15, 20 years? There are going to be plenty of people in Auckland and a number of people in suburbs in Christchurch that will be absolutely forced out when they stop earning, when they retire.
Well, I've seen one of the big economist firms is saying that there's going to be a whole group of poor pensioners in about 10 years' time because they won't be able to afford rates. They'll have to move out of their houses. They won't be working, and they're going to have to live on the pension. And it's all because of these ridiculous costs that people are facing now. And even though house prices are going up, that just makes the rates even more unaffordable.
Well, it may not be quite as miserable as that, but it may require people to make extensive changes that might require them to go and live in Te Awamutu or Oamaru or somewhere like that where they're completely unfamiliar. However, let's keep an eye on these rates revolts, and we'll see how they go. They may have some effect.
Yeah, moving on, and possibly someone who doesn't worry too much about rising rates is the NBR rich lister Alan Pycris, who I understand is selling some of his property interests.
Well, actually, Alan is the kind of guy that would worry about his rates. He'd worry about how much petrol he's putting in his car, actually. He's the kind of millionaire who does not have toys. He does not have planes, boats, and all that sort of thing. He once boasted that he never sells anything. Well, he does sell things, obviously, when the price is right. But he's selling off a little piece of land in Australia, a small business, I should say. Not small by yours and my measures, but small by his empire. And he's just breaking up a joint venture over there, which he told me it involves about a tenth of his empire. So that's not a huge thing. But Alan is moving ahead in Canterbury. Again, he's got a number of farms here, dairy farm operations, and he's doing this with money that he received from the sale of a shareholding he had in one of New Zealand's largest dairy companies called Dairy Holdings, which he sold out of last year. And he was very pleased to tell me that he had sold out at a very opportune time because you may recall a year or two back, dairy prices were at their height. So Alan probably got full value for his shares, for which he's very happy about.
You're listening to Property Talk with Chris Hutchings and Sally Lindsay. And Chris, you're running a story about a fairly happy landlord in Wellington.
Well, we have Caldy and Staines, who we may have talked about this a bit before in some other radio station items, but as everyone knows now, it's been taken over by David Jones, and that has been greeted with, has been positively greeted by one of the people that comments quite a bit on these matters. His name's Paul Keane of RCG, which is a consultancy, commercial property and consultancy. He thinks that the entry of David Jones is a good thing, and that Caldy and Staines just was not cutting the mustard. That follows retailers come and go. You know, over the past 20, 30 years, we've seen so many names come and go. Very volatile industry area to be in. Recently we had Arthur Barnett and Dunedin, which was a huge name, just like Caldy's, taken over by H&J Smith. And we're going to see more of this sort of thing as retailers go through adjustments. It's not so much competition, I don't think, from online, because it's still relatively constrained, although it will be an aspect of it. But according to the consultants, Kikuldi's just wasn't really doing it. The showing didn't seem so great. That's all very arguable, but that's what the consultants are saying. So we look forward to a new era in Wellington. Kikuldi's now David Jones.
Now, Sally, you've got an update on this Auckland or proposed Auckland Council inquiry into the events business.
Yes, well, it's quite interesting. The Chamber of Commerce have asked the Auckland Council to hold an inquiry into Regional Facilities Auckland, which is a council-controlled organisation, and it controls a lot of event centres around Auckland. The council has said no, they're not going to hold an inquiry. They don't see any reason to. And in fact, they told Michael Barnett, the Chief Executive of the Chamber, that in fact they didn't like his approach and it was very unprofessional. He says he doesn't know what was unprofessional about it, and how can it be unprofessional when 40 businesses have approached him complaining about what's happening. And so the businesses are saying that the Regional Facilities Auckland has actually bought $12 million worth of its own equipment, is undercutting them, and has also installed one overseas business to provide all the catering, and there's no alternatives for people that want to hire the venues. They've got to hire their council equipment and they've got to use their caterer. And that is also cutting them out of business. One person said they've lost $1 million worth of business and contracts. So the council has referred the Chamber of Commerce to Regional Facilities Chief Executive, and Mr Barnett is hoping that he'll get some satisfaction there, but I doubt that will happen. Regional Facilities Auckland is just a little empire unto itself, and it will keep on going, like other council-owned organisations.
And that's it for this week's edition of Property Talk. My thanks to Sally Lindsay and Chris Hutchings.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To the music industry, Apple has used its annual developer conference in San Francisco to preview Apple Music, a new subscription-based app for iPhone, iPad, and yes, Android that will launch June 30 and provide all of your music in one place. In a statement to NBR, Apple said there would be a 3-month free trial from June 30 and that local pricing will be available closer to launch. American pricing will be US $9.99 a month or US $14.99 for a family plan of up to 6 individuals. Apple wants to move people from the habit of buy and download to subscribe and stream. That's not a new idea. Spotify and Pandora are the most established players providing so-called internet radio services that are no cost or low cost, with better quality audio and the ability to skip ads. US media is saying Apple aimed to offer its new service at half the price of established players Spotify and Pandora, but it failed to reach deals with major music labels that would accommodate such a move, meaning Apple Music will be only slightly cheaper. Apple Music will combine full album streaming already offered by Spotify, RDO and newcomer Tidal with a 24-hour radio station called Beats One. Beats One will be hosted by real DJs in New York, Los Angeles and London, such as Kiwi expat Zane Lowe, son of veteran broadcaster Derek Lowe, who Apple poached from the BBC. The Apple Music app will feature a selection of Connect, where artists can share demos, live recordings, videos and other content with fans on their own profile pages that users can follow. Again, that's not unique. Many artists make bonus material available through the likes of YouTube, SoundCloud, and existing music streaming services. However, Apple is touting the convenience of having every feature offered by rivals all in one app. In business news, the landlord of Kirkcaldy & Staines in Wellington has attained a new and more stable tenant with the sale of the department store to the David Jones chain. The upgraded Harbour City Centre store at 165-7 Lambton Quay was sold to Wellington property investor Charles Yen for $45.85 million in September 2014. Company's office records show the property is owned by nominee company Jones Cooper Partners. The gross price paid for the property was $50 million. It has a rateable value of $6.3 million. The nosedive in Kirkcaldy & Staines' financial performance in recent times represented warning signals for the landlord. If Kirkcaldy & Staines had gone into receivership, the lease may have been cancelled if an administrator decided to close the business. David Jones will acquire the Kirkensteins brand for 400,000 Australian, with an option to buy $500,000 worth of chattels. While one investor rang NBR bemoaning the loss of Wellington's heritage brand, the share price jumped on the news. Meanwhile, commercial property consultant Chairman Paul Keane says the David Jones takeover is brilliant for Wellington. It was inevitable, he said. It had to happen in terms of what Kirkensteins was doing or not doing. It just wasn't performing. I signalled a few months ago, he said in a newsletter to clients, that it couldn't last. The store itself was uninviting with its stud height. Mr Keane says the entry of David Jones is remarkably good for Wellington and for New Zealand because it's likely they'll increase their presence in other centres. The company was here about 15 years ago looking for an outlet in Lambton Quay. It will reinvigorate the area. Kirkaldi's directors last week told shareholders the David Jones deal offered the opportunity to realise cash resources from the proceeds of the sale of the Harbour City Centre and any other funds remaining after the costs of winding up the company. After completion of the takeover, the board will look to make an early and substantial distribution to shareholders from its available cash.
This is NBR Radio on Tuesday, June 9th. I'm Owen Poland, and joining me in the studio is technology editor Chris Keel. Chris, the local technology community seems pleasantly surprised that the IRD has chosen US company Fast Enterprise to lead its $1.9 billion upgrade.
The reaction's been generally positive. We've got lobby groups like NZ Rise who've been pushing for more local contributions, but there's also been a lot of local advice to the IRD, and part of it has been that they should use off-the-shelf software where possible, and they've named Fast Enterprises as a provider of off-the-shelf software, which will probably be a reasonably small amount of the overall $1.3 to $1.9 billion project, but it's regarded as a smart move.
What can you tell me about the reputation of Fast Enterprise?
Well, I often say that software projects are like extensions to your house. There's never been one in human history which has come in under budget. They're typically late and around double the budget. We all know the story.
Sure.
We're familiar with it from Nova Pay and the INSYS project for the police and so on and so on. But remarkably, it seems that Fast Enterprises has a good track record. Ben Gracewood, who's an IT commentator, has pointed out that they did a project for the US state of Pennsylvania, which actually came in on time and under budget. So they've definitely got a good rep, and they're actually familiar with IRD systems because a number of people who are now at Fast had a role in creating the previous system.
At the same time, some observers are seeing this as a snub to the big guys, SAP and Oracle.
Yeah, although Fast Enterprises is an offshore company, it's reasonably small with 700 people, which makes it smaller than some of the big New Zealand companies, compared to SAP and Oracle, which have got tens of thousands of employees and are quite multinational, multi-tentacled. And a couple of people that I spoke to for my article felt that they've got a bit of a rep for going over budget with big projects, and at times they've both been embroiled in legal controversies over costs.
Yesterday's IRD announcement also flagged that around 30% of this upgrade is going to go to local firms. Any idea of how that might play out?
The IRD minister has previously said that around 30% of the work, or 30%, will go to New Zealand owned and operated companies, and the lobby group NZ Rise is very keen to push this through. That spokesman Don Christie was saying to me last night. However, like everyone else, he's still looking for more detail as to how that work to locals is going to come through.
And also in terms of the interface with the local accounting firms, the MYOB and Xero, is there additional detail there about how the IRD are going to work with both of those companies? Yeah,
there were sort of hints in that direction. Earlier, Rod Drury wrote an opinion piece saying that IRD could shave $500 million off the cost by just doing the core system, the central system, and leaving the front end, or what everyday punters use when they want to reach IRD on the web, to leave that front end to commercial companies like IRD and MYOB, just publish a basic spec and let the commercial software companies build it at their own expense. Yesterday, the IRD said they would let firms like Xero and MYOB plug into their new system, We've got Don Christie at NZ Rise saying, well, that's just like an API, and it's people have been doing that since the mid-90s. You can plug your software into someone else's software. That's not quite the same thing as letting the private companies build the whole front end. So that we've yet to see the final design of the project, but my sense is that even though Bill English has made encouraging noises about Rod Drury's proposal, that in the end it's going to be about control, and the IRD will want to keep things tight. They won't want to give up control and let that front end or go to private enterprise.
Thanks, Chris. That's Chris Keel, NBR Technology Editor.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.